Hello, and welcome to this Lexology webinar. My name is Patrick McGauley. I'm an editor here at Lexology, and I'd like to thank you all for tuning in. We have a really great presentation lined up for you today entitled Taxing the Digital Economy, Pillar 1. Our expert speakers today are Paolo Ruggiero and Jimmy Vandersvan from Taxand. Paolo is a partner at LED Taxand, which is part of Taxand Italy. He has more than 15 years' experience, particularly in international taxation. He mainly focuses on private equity and real estate transactions, as well as international tax planning, merger, and acquisitions. Jimmy is a partner with Taxand Netherlands and a core member of the global Taxand Energy Service line and Transfer Pricing Service line. He specializes in the energy sector, covering aspects relating to oil and gas, suppliers and contractors, electricity, alternative resources, and renewables. So there are just a few general admin points to mention before we start. First of all, please use the online question tool to post any questions that you have, and I will address them to our speakers after the presentation. Secondly, if you have any audio-visual problems during the presentation, please let us know by using the online question tool, and we will do our best to resolve them. And finally, just to note, a recording of this session and the PowerPoint slides will be posted online, and we will send a link out to all webinar attendees. Please use the link and send it to any colleagues who you think may be interested in today's presentation. So without further ado, I'd like to hand over to Paolo and Jimmy.
Thank you, Patrick, and thank you everybody for dialing in on this webinar. Our webinar will take approximately 45 minutes, and thereafter we will take questions. And this seminar is the first part of a second one, which will take place in June on pillar 2. And during this presentation, we will turn off our cameras, but we will have a vision again when we start with the Q&A. So we'll turn off our cameras now. And I'll try to show you the content of our today's presentation. As you can see, we will first deal with an overview of the digital economy. Thereafter, the unilateral measures already taken, and then we will dive into the Pillar 1 project in more details. And afterwards, as said, we will deal with your questions that you may have. Questions that we cannot answer during this hour, we will follow up on by email after the presentation. We thought it would be good to first share with you why the digital economy is becoming so relevant and why this has been put on the agenda of the OECD. And we feel that the next slide is a good indication which shows the traffic over the internet since 1992. And as you can see, it's increasing tremendously, and likely the COVID crisis for sure will have an additional impact on this, and for sure it will not decrease the traffic over the internet. And this is an overview of the likely well-known companies involved in the digital economy nowadays. And as you can see, most companies are based in America and in Asia, a smaller group in Europe, and a tiny part in Africa. But this is, of course, only the place where the companies are residing and not where the consumers are based. And that indeed is where the tension comes from. Normally we used to tax the companies in the place where they reside, but this is felt to be unfair since all the consumers, or many of the consumers, are not based in the countries where the companies are based. And Paolo, may I hand over to you now for the next slide, giving an overview of the unilateral measures there are.
Yeah. As Jimmy has pointed out, in principle, the taxation residence versus source does not fit very well into the digital world. And that's why lots of countries, especially this is an overview of the European country, have tried to implement their own model for taxation, the digital world. And as you can see, there are lots of countries from France to Hungary, Italy, Spain that have implemented or are trying to implement digital services taxes. It has to be said that in principle, at least EU countries are implementing the digital service tax according more or less with the EU directive. But even though there is this common background of the EU directive, nevertheless, when you apply their own digital service tax, there could be double taxation. And and of course, the double taxation at EU level is something that the Commission does not want, because this hampers the single market. Another thing is that it's difficult for the EU state in implementing the digital service tax is that, in principle, as you may know, the direct taxation is not very well harmonized at EU level. But nevertheless, when each member state tries to implement new taxes, these new taxes should in any way be coherent with the four fundamental freedoms. So, and that somehow it's not very easy to design a taxation, a DST at EU level that in principle does not discriminate among resident and non-resident. If of course digital service tax is not only an European measure. If we move on to what happened in the world, here you can have a summary of all the proposed DST that will be implemented in all the continents, in the four continents. For example, you see that Australia and New Zealand are try to implement digital service tax, America as well, Brazil, Canada, Chile, Mexico, and you see Africa, Asia. So all over the world, there is this need to tax the digital economy. And of course, every DST has its own feature. And you can see for a multinational how it's not very easy how to administer every single DST in every country, especially when in such a country you do not have even a physical presence. So it could be very time consuming. And there are lots of cost of compliance. That's why at OECD level, let's say, they try to implement the pillar one, not to go in order to tackle this implementation, single implementation of the DST. There are other reasons why DST is not in principle the best option, and we can see in the next slide. The first things, as you can see, is that all DST, at least as they are implementing so far, leads to gross taxation that are based on turnover. And even the EC directive look at the gross taxation. And for sure, that gross taxation, of course, with the reduced rate is a proxy of the corporate income tax, but for sure, it's not the same. Then, as already said, the uncoordinated adoption of unilateral tax measure may cause double or triple taxation among the countries, and especially in the developed countries, it's not easy to design a DST that does not really conflict with the international tax treaty rules. There is also a debate in Europe how you can design a DST that in principle is not a proxy of a corporate income tax, and so it goes against the double tax treaty. And another point that we should have bear in mind is that it's very difficult to secure the revenues from a DST, especially when there are foreign companies. You are going to tax foreign companies that have not a physical presence. So this is a crucial point for developed and developing countries. And also the adoption of withholding mechanism, it's not easy to implement especially in a B2C environment. These are just some features or some issues that every single state has to face when implementing a digital service tax. So Jimmy, up to you. Okay, now we just want to give you a little background where we are and the thoughts on the digital economy. And in principle, everything starts in 2015 because BEPS Action 1 was addressing the tax challenge of the digital economy. And in 2015, BEPS Action 1 report noted that the digital economy was characterized by a reliance on intangible, by the massive use of data, and especially personal data, and a widespread adoption of multi-sided business models. And according to this feature, the challenge, there was a challenge, the question of how taxing rights of income generated from cross-border activities in the digital age should be allocated among countries. Of course, every countries at that time, or most of the countries, were aware that was not enough the existing rules. And in principle, we can also say that at that point in time, there were three main positions among the countries. One countries that say that new rules should apply only to the digital economy. The first group that already was considering that the economy were everywhere went to digitalized, so there was impossible to say how the company should be tackled from a digital point of view. So the new rules should apply to every company, every multinationals. And then there was a third group that say, oh, BEPS project is enough, and already there is no more a misalignment among the value creation at where this value has been taxed. So these were the three positions. Then the OECD came up with the public consultation document. In this public consultation document, in principle, in order to tackle the digital economy, there were three proposals. The first proposal was user participation proposal. In principle, the idea behind was there was a sustained engagement in the active participation of a user in a market, and this means create value creation, and therefore in such a market should be allocated part of the taxing right. The other proposal, the second proposal, was the marketing intangible proposal, and this proposal was just to address only highly digitalized business. And there was the third proposal, that the significant economic prison proposal. And here there was a main broader concept according to which they say we should move from the old concept that only physical presence, a state may tax only where there is a significant physical presence. We should move from this concept and find a new NEXUS rule. Of course, as already Ginny said, the pillar 1 matches with also an overview of with pillar 2, the next slides. Here we say that we combine the two approaches. The pillar 1, the proposed unified approach, try to find a new nexus right, a new allocation of taxing rules. And this goes with what is called the global anti-base erosion. And we have a further seminar on pillar 2, and pillar 2 combines two rules, basically the income inclusion rule and the undertax payment rule. What is the end of the story? The end of the story should be, at least the OECD think, that by the end of 2020, still there will be a consensus on pillar 1. As you can see, in July 2020, there will be a virtual inclusive framework meeting, virtual because due to COVID restraint. In October, there will be the finance minister meeting. And finally, they think that by the end of December, November 2020, a final, a comprehensive solution on pillar 1 will be reached.
Yeah, and then it's now time to dive into the details, or a bit into the details of the pillar 1. As Paolo said, it's a challenge to combat the digital economy, and the OECD already did or started discussion in the 90s in this respect to see whether, for example, a computer service could be considered as a permanent establishment, because they were always looking at taxing physical presence, whereas now countries are considering that the market jurisdiction is becoming more relevant, and it feels a bit like more a kind of a sales tax into the local jurisdictions, for which reason, of course, you have to create new nexus rules as apart from the physical presence. The whole system that we are currently having, so the tax system we having, are always based on the bricks and mortar, because they are easy to identify, and by moving that direction, they are also moving to a formulaic apportionment, which is something opposed to the system that we have been applying so far, which is the arm's length principle, or the ALP. And that's also one of the big challenges I foresee in the whole project, because the arm's length principle is based on economic system and economic theories, which allocates profits to functions, assets, and risks, which is a kind of a mathematical way of looking at allocating profits, and that's completely different compared to the formula apportionment, which is much more politically driven, because it determines by way of reasoning or preference which profits should be allocated to a certain jurisdiction, and it really is a question whether those two systems can be tied into each other and resulting in a attractive or reasonable result in the end. There were people saying that the arm's length principle being applicable also to companies and permanent establishment could have been applied or altered if, for example, permanent establishments should no longer be permanent or physical, but could also include digital. And then if you consider client base or consumers as an asset, then you should have been able to allocate profits based on the assets allocated in a certain jurisdiction. But that for sure is not the way the OECD is going forward. So they are going the way of the formula apportionment, as we will see in the next slides. But let's first discuss which companies will be in scope of the Pillar 1 project. And as you can see in this slide, the Pillar 1 will cover, on the one hand, automated digital services, and on the other hand, consumer-facing businesses. And I think that automated digital services, that's a more clear case on what should be covered by that business. So it are online search engines, social media platforms. So you can think of the Facebook, Instagram, Google kind of companies. But there needs to be some further defining done, which is work in progress, like a number of other items that still needs to be further discussed within the OECD. One thing which likely will be excluded is digital services that do require human interference. And as examples, people are referring to legal or accounting services that could be rendered digital, but do require human interference. But it's clear that the automated digital services not only apply to B2C, but also to B2B, whereas the consumer-facing businesses is intended just to focus on B2C, so only where businesses are delivering or services or selling goods directly to the end consumers. And it should also apply if companies are selling through third parties and the reseller is just repackaging or just very little involved in assembling activities. Then this is an overview of the listed activities which will be in scope of the consumer-facing business. It's indicated by the OECD that this is a non-exhaustive list of activities, so it could be that other activities will be added to this list, but perhaps it's also good to deal with the exceptions to this, which is also, of course, very relevant. Is being said that the extractive industry, so the oil and gas and mining industry, will be excluded from Pillar 1, reason being that those companies already are subject to special tax regimes in the country in which the commodities are extracted from the ground, so the raw materials are already taxed in the countries where these are extracted. Likely the financial service sector will also be excluded, likely based on the fact that those are already subject to a very strong regulatory regime in the country where the services are being rendered quite often also already triggering permanent establishment issues, and also the transport and sector and logistics will be excluded from Pillar 1. A number of issues that we foresee will be difficult in further developing the Pillar 1, but which should take place before the end of this year, is how will you divide activities of a company if companies are both delivering services B2B and B2C, whereas as I said, the majority of the services are in scope are just B2C activities. Another big issue will be is how companies should react if they have a strategy which is both focused on digital services but also on physical, so having shops all over the world but having a online web shop next to that, and how should companies tie that into their current administration, which of course will require them to amend their reporting as per today. Another issue will be how you have to deal with companies that do sell their products to end consumers, but at the same time do sell products to other companies that incorporate these products into new products sold to consumers. So all in all, quite a lot of issues that need to be covered before the OECD can implement Pillar 1. And then we move on to you again, Paolo.
Yeah, the new Nexus is another crucial point in the Pillar 1, because as already said, physical presence is not enough, so we have to find new rules in order to say that a market jurisdiction can have taxing right. And in principle, the indicators is the OECD says that in order for a market jurisdiction to tax, there should be a significant and sustained engagement in that market. But there are two, in principle, the new Nexus once again can be divided in two parts. One is related to the automated digital services, and the other one is related to the consumer-facing business. As far as the automated digital services, in principle, the Nexus is simple. It's the revenue threshold in a market jurisdiction. It means that when we are facing the digital services, once you reach a customer in a market, it means that that market has the right to tax. While for consumer-facing business is different, because the OECD, as far as the consumer-facing business is concerned, still says that the mere fact that I sell in a country, there are sales in a country, is not enough to for that country to tax. So there should be not only sales of goods, but something else. The problem is that these additional factors has not yet been has not been yet ready to be delivered. So it could be physical presence, it could be targeted advertising, it could be data collection. We do not know. What I can see is that physical presence, in principle, you already have the P concept. So what else if we should depart from the P concept but still have physical presence? As far as data collection is concerned, in principle, it's difficult because sometimes data are getting from a whole region. It's difficult to see also from a technical point of view where you are getting data, especially when there are people that are moving around the world. For sure, the OECD is concerned that this new NEXUS rule should be a standalone rule in order to limit potential interaction with other existing tax or non-tax rules. And moreover, this new NEXUS should in any case be designed in order to limit filing and related tax obligation. So also on this point, in principle, the idea is that the location of the consumer in a country should attribute the revenue to such country. In principle, so it means consumer, sales, location, taxing. But then when we go to the real life, in principle, there are lots of issues that have to be resolved. For example, how to trace the final destination of the goods when they are sold to a series of third-party intermediaries that are located in different jurisdictions. Because as Jimmy says, in principle, I can sell, but I can have my own distribution network, or I can use third-party intermediaries. And if I use third-party intermediaries, I have only one intermediaries for a region. For example, in Europe, how can I trace then where the goods are finally sold? Another issue is how to source the online advertising services when the advertising is displayed, for example, in country A, but the buyer is located in country B. If we look in the digital world, for example, we can say that I sell the advertising in France, but it could be that this advertising is displayed in Italy. So which is the sourcing rule? Which, in such a case, which is the country that can claim a taxing right? Is the country where the buyer is located, or where, in principle, the advertising is displayed because there are the final customer? This is another crucial point. And then also the data collection, because we all know that in principle we want to tax digital giants such as Facebook, Google, and so on. But in principle, we have to bear in mind that lots of the apps where the data are collected are free apps like Facebook and Gmail. So in principle, there is a collection of data from apps that are not that are free app. But nevertheless, I exploit the data from a country and I can sell and have value from this data. So in such a case, where is the sourcing rule? What the sourcing rule can we have in order to say that a market jurisdiction, even if there are not consumers, has the right to tax because data are collected from their end? These are only some issues relating to the sourcing rule and in order to allocate to a market jurisdiction, let's say, the value added deriving from the digital economy. Jim. So up to you, Jimmy.
Apologies, I was muted. Apologies for that. And now we will dive into the new profit allocation rules. So the rules that will be replacing the arm's length principle and will be moving to the formula apportionment, which rules can be quite mind-boggling to say the least. There are three amounts which are relevant in this respect, and we will detail those out further down the presentation as well. It's intended that amount A is part of the residual profit that should be allocated to the market jurisdiction, so the jurisdiction in which the consumers are based. A thing which needs to be further defined of which part of the profit should be allocated to the market jurisdiction. So there will need to be a division between residual profit allocated to the headquarters, for example, based in the US, and the market jurisdictions around the world. But which part of the profit shall be allocated to those foreign jurisdictions is still unclear. The amount B is a kind of a fixed rate, which will be based on a kind of baseline marketing and distribution function. So it will be a relatively low margin to be allocated to the local markets for baseline services, and this remuneration will be based upon the arm's length principle. But this will just cover the routine functions that a company performs, whereas amount C is a non-routine profit that can be allocated to a certain jurisdictions in which more activities take place, or which should get more a bigger part of the profit allocations, because, for example, if there are certain local marketing assets in that jurisdiction, and it's obviously that these three amounts will tie into each other, because all profits can only be taxed once, and amount C and amount B, of course, will be reducing amount A. At least that should be the plan behind Pillar 1. In order to ensure that companies, in order to ensure that the burden for companies is limited, so that not all companies are subject to these rules, one is considering that the rules should only apply to really the big companies, meeting also the country by country threshold, which is currently set at 750 million of revenues. People are making reference to the same threshold, but that still needs to be determined. At the same time, one is also considering rules for de minimis, or rules for profits to be allocated to a certain market jurisdiction. So there should be at least a minimum amount to a jurisdiction before you should become eligible to registration and reporting taxes in such a jurisdiction. What of course remains difficult is that these amount A, B and C only relate to business lines in scope of Pillar 1, and the physical business remains outside scope. So one needs to make a split in the financial administration. And as we can see in the next slide, here amount A will be based on the consolidated financial accounts. That could either be US GAAP, IAS or IFRS, but it's uncertain yet which one of the regimes should be applied and how we should handle the difference between these regimes. The OECD mentions that the differences between the regimes are mainly based on timing issues, so that it should not be a big issue to apply either one, but it's still a thing which needs to be determined. Another item also that also came forward from the public consultation is that it should be the profit before tax, which is the indicator of the profits to be allocated between the companies. And so you should make a tax adjustment, either positive or negative. How companies are going to provide insight in which business lines are in scope or out scope, of course, is still to be determined. And the next slides provide a good overview of how the three amounts tie into each other. And it's good to mention that the allocation keys and the share of the profit to be allocated to a market jurisdiction can differ per industry, per region, and per business line. And that's still under a negotiation within the OECD. And that's a thing which should be managed before the end of this year. And especially the differentiation between regions or type of businesses, we feel is also a political issue, which of course can bring insecurity, because it's unclear whether these allocation factors, the formulas, will amend if the political colors change within the world. And then Paolo, I hand over again to you, because you can deal with another interesting topic, the loss carry forward or loss impact on Pillar 1.
Yeah, exactly, Jimmy, because of course, if we consider the multinational in its overall business, we have to take into account that multinational does not always have profit, but it happens that they may have a loss. So it has to be taken also into account the tax losses impact. And in principle, we can say that the market jurisdiction should share also the risk that a loss may come up at the overall level. And so they can only say it's unfair, let's say, if a market jurisdiction can take a part of the pie only where it is good times, but does not take into account any losses when the business goes bad. So, and in principle, the mechanism that has to be envisaged to manage also the tax losses are mechanisms that we already know, like carry forward or carry back of the losses. This is the most likely mechanism that will be implemented. And another point also is the transitional period, because of course the amount A and these new rules will change dramatically the international taxing rights. So we have also to manage the transitional period, what we have do so far, and what will be the new world, and how, for example, the losses that have been accrued pre-amount A regime will be taken into account. Another critical point is that if we insert a new layer of taxation, this amount A, of course, we are creating a double taxation. So there is also a double taxation impact. And of course, at the OECD level, we cannot stay with the double taxation. So the amount A somehow should be relieved. And at this stage, at the OECD level, they are more inclined to relieve the double taxation by using the mechanism that we already know, the tax credit mechanism or the exemption mechanism. But the problem here is more than on the mechanism, is on the entity that should apply for the relief. In principle, we can say, okay, if there is a taxation and if there is a consolidation of the income, in principle, the parent consolidated entity could be viewed as the company that should relieve the double taxation. But also in such a case, is this fair? Because at the end, we share the pie, but then on the parent company should be the burden of relief all the double taxation that may arise. Is it so? Is it possible to apply instead for a split method among different group entities? Because there are entities according to which, for example, that manage the intangible, they should for which they have a non-routine profit. So in principle, since the amount A, amount C somehow interact, it's possible that, or it's fair that part of this profit, for example, the amount A should be relieved by the company that gets the amount C. But this is our issue that are unclear and have to be addressed at the OECD level. Then, Jimmy, to you, the amount B.
Yeah, thank you for that, Paolo. And some further comments on amount B. As indicated, the amount B is an amount which needs to be determined on the basis of the arm's length principle. So it's not that we completely say farewell to the arm's length principle, but we have to tie this into the formula apportionment of amount A, and it's also not. It cannot be applied as a safe haven. So one still needs to determine which routine profit should be allocated to the routine functions or functionalities, taking into account that it should not involve any ownership of intangibles, and all the activities remunerated under amount B should be of limited risk. And of course, this functionality will differ from industry to industry, so it's an extra level of complexity in the whole setup of determining the overall profits to be allocated. But that's not much more different than amount C, on which you will be elaborating, Paolo.
Yeah, in principle, we say amount C is completely, as you can see, determined according to the current TP rules, and in principle is the remuneration that should go to the non-routine function beyond which is the baseline distribution activity. And for determining the amount C, we still use the current TP guidelines. Why the amount C is somehow important? Because the amount C is the amount at stake when I think there will be a tax assessment by the tax authority, claiming that, for example, in a jurisdiction, there are companies that goes beyond which is the baseline distribution activity, and so try to remunerate such company with part of the amount C. And therefore, here and the OECD is aware of this, we need a strong dispute resolution mechanism. Otherwise, it doesn't work the interaction among amount A, B, and C, because every time you try to move the amount A to B or C, of course there is mechanism there is double taxation mechanism that have to be relieved. That's why the OECD is very aware that a strong resolution mechanism should be applied. Amount C, I would say that amount C is the amount that still goes with DP rules. Why? Because amount A, as Jimmy said, goes with an apportionment. Amount B, in principle, is driven by TP policy, but there are fixed amounts, so somehow our TP policy pre-agreed. So the amount C is where still DP plays an important function. And that's why I think that the interaction among the major interaction will be most likely amount A, amount C, especially when you can have in a country already an amount C, but also this country could qualify as a market jurisdiction. So there is another part of the pie that is attributed to this country. So when you move C and A, who should relieve within the same country if there is already amount A, amount C, or anyway at the parent level? These are all issues that of course have to be resolved at the OECD level, and here a strong resolution mechanism for sure helps very, very much. So I think that we are finished with the presentation. We have I don't know if there are some questions. We can go with this last 50 minutes with the question.
Yeah, thank you, Paolo and Jimmy. That was really great. So as Paolo mentioned, we'll now get both of our speakers to field some of the questions that we've received. So just as a reminder to any attendees who haven't sent through their questions as yet, please feel free to send them on now using the online question tool. So our first question concerns the slide about business sectors. And the question is, does the proposal catch distant sales of goods through online shops, or does there need to be an intermediary?
Yeah, thank you, and a good question. And the way I read the current proposal is that such consumer business should also meet the new NEXUS rule. But Paolo, feel free to chime in. So you will require a certain physical presence in such a jurisdiction before you can become subject to these type of rules, and it will require further definition of the physical praxis or the nexus that will be required. We had a discussion in our firm a couple of days ago on this, and I think if you would, for example, have car sales online from one jurisdiction into another jurisdiction, and you have a service branch or service presence in that customer jurisdiction, that should be a trigger for becoming subject to the digital service taxes. But Paolo, please feel free to add if you would like.
Yeah, I do agree with Jimmy, because this is also the question that arises, for example, in DST. If DST in such a case is an online sale or shop physical goes within or without DST, I can say that UA level it goes out. So in principle, the sales of physical goods through an online shop in principle would be not coded by the DST as well as by Pillar 1. As Jamie said, there should be something else. Yep.
That's great. Many thanks, Paolo, and many thanks, Jimmy. So our next question is, do DST charges apply to intercompany charges between affiliates related to sharing third-party digital services costs? For example, a parent contracts with a digital service provider for the global organization. The parent then charges or allocates out the costs to the benefiting affiliates. Would the parent or affiliate transaction be subject to the DST?
In principle, I tend to say no, because intercompany transactions are excluded. So I would say that intercompany transactions are excluded from digital service tax.
Jimmy, would you have anything to add?
No, I think, Paolo, I agree with you. When I first read the question is, but then just reading the first part, I was I thought that the question would read that how to deal with intercompany charges, more relevant in relation to amount B, and that I think is still also a point which is under discussion on how to deal with such allocation of cost, which normally, of course, is tied into the arm's length principle. But rereading the question, I agree with Paolo's comment.
Okay, great. Thanks very much, Jimmy. So our next question is, do you believe the timelines for Pillar 1 the OECD is aiming for will be impacted by the COVID crisis?
Short answer, no, I don't believe so, because I think the OECD is very well capable of doing online meetings. They also indicated, I think, that they are very keen on meeting the deadlines. And I also think that due to the COVID crisis, more businesses are moving towards the digital economy, which only makes it more relevant that these new rules are being implemented. And what we saw with the BEPS action plans when they first were announced, everybody thought that that the OECD would not be able to meet the deadlines, but they did. Their speed is tremendous, and they have shown to be more powerful over the last couple of years, I think, than they were in the past. So it's my estimation that they will do anything they can to come to an end towards this year. But then, of course, these measures also need to be implemented in local rules, and these need to be amended into the double tax treaties. That for sure is also a thing which requires some time. So when ultimately the rules will be applicable, perhaps it's a bit of a gray area, but I really do expect that towards the end of this year, we will organize and host a new webinar being an update on this one.
Yeah.
Many thanks, Jimmy. Sorry, Paolo.
Just one comment. I would just my only concern is that for sure the OECD wants to do the job by the end of 2020. My only concern is rather than from an economic policy perspective, means that in principle with COVID, in order for the economy to recover, we say there are monetary policies, but also fiscal policies. So to the level of taxes, we should not raise more taxes to booster the economy. So for me, somehow the digital economy may impact because I see it as a new additional level of taxes. So how to know with COVID how to cope this with the fact that in principle fiscal policy should instead be flexible and should foster the market. This is only my concern about Pillar 1 and COVID. It's more from a economic policy view.
Yeah.
That's great. Many thanks, Paolo. Sorry, Jimmy, did you have anything else to add?
The overall tax burden should not increase due to Pillar 1. It's just a different division or allocation between countries. And there, of course, there's a risk that due to the crisis, jurisdictions will have a bigger interest in claiming their fair share. And if there is a budget tension, then, of course, the fair share immediately needs to be bigger.
Great. Many thanks, Jimmy and Paolo. So our next question is, are corresponding changes to DTSs anticipated on a multilateral level?
Yeah, Jimmy. Yes, I think that this new rule should be implemented somehow in the line of what has been done with the MLI. Through, of course, they should work at the global level. So you need a global instrument like the MLI is. You cannot change each single treaty, otherwise the Pillar 1 approach does not work anymore.
Yes, I agree, and hopefully the implementation will be a bit more simple, because they are also still considering how the registration should take place and where you should pay your taxes. And if you would do a registration but with a single point of payment of the taxes, and then the jurisdictions divide the taxable income amongst each other, then it also should be fairly easy, or at least easier, to also apply a multilateral kind of instrument preventing double taxation, etc. But that's still work in progress, and for sure will need quite a bit of attention.
Many thanks, Jimmy, and many thanks, Paolo. So moving on to our next contributor question. So will the measures apply only to MNESs with the same threshold of revenue as required for CBC reporting?
Well, the intention is to have a threshold indeed, to ensure that not too many companies get the burden of registration, compliance, potential disputes, etc. Reference is being made to the country-by-country threshold being 750 million of revenue. So yes, likely this will be the same threshold, but is also still a work in progress. And I know that in France they also implemented unilaterally a similar rule using this threshold, and then they did find out that also some French companies were targeted by their own rules, which of course was not the intent, and jurisdictions will for sure have a closer look at their own companies before they agree on a certain threshold. So the short answer, yes, there will be a threshold, but the amount will still work in progress.
Many thanks, Jimmy. Paolo, have you anything to add to Jimmy's answer?
I can say that for DST in Europe, the threshold has been the same, and also when unilaterally implemented, more or less the threshold has been kept the same with the CBCR report. Yeah. So I think that at the end, this is something that the consensus is already agreed, I think.
Right. Many thanks, Paolo. So our next question is, why is Pillar 1 applicable only to the BTC sector and not to the BTB sector? For example, why would an MNE be outside Pillar 1's scope if it sells to an independent third-party wholesaler, but would instead be within Pillar 1's scope if it has its own distributor network?
Paolo, do you want to take this one? Or?
I don't know. In principle, I don't know, because we already seen that for the digital economy, B2B is equal to B2C. For the consumer-facing business, it's different. In principle, how you to draw the line, it's very complicated. Still, I think that is something complicated, especially when you have your own network, distribution network, and you have not. I think that there is not, for me at least, it's not clear where you draw the line, and the rationale behind, I don't think, I don't even have a clear view on the rationale, because for me, B2B and B2C, when you the digitalization of economy is everywhere. Everywhere you can get the data. Everywhere you more or less use the same. So I don't know why stick to the consumer as a person and not goes wider to the B2B also.
Fully agree, Paolo. It does feel to be a bit unfair. Of course, I think the background was that especially the big multinationals like Facebook having big audiences in the rest of the world were the starting point from the discussion. At the same time, I think that B2B perhaps is also less of a focus of the OECD, since businesses quite often do have a physical business presence, which is already subject to tax. Consumers are much more difficult to target if they do not carry on an enterprise themselves. So B2B is already much more covered by the existing taxing system, which taxes a physical presence, and most businesses do have a physical presence somewhere, so are already being taxed. But this exactly was also one of the comments in the consultation documents that many companies, but also advisors made. Why not apply it to B2B as well as B2C?
Many thanks, Jimmy. So unfortunately, the clock is against us. So I'd like to thank both Paolo and Jimmy for a really excellent presentation, which covered a host of really important points. And I think our listeners will have gleaned a lot of useful information from today's webinar. And I'd just like to tell any of our listeners that all unanswered questions will be sent to the speakers after the session. So just another reminder to attendees that we will send out a link containing the recorded session. So please keep an eye out for that. And as I mentioned at the start, please send the link on to any colleagues who you think may be interested in today's presentation. So I'd like to thank you all for participating, and I'll hand over to Paolo and Jimmy to say their final goodbyes.
Thank you. It has been a pleasure.
Thank you. Same for me, and we'll sure answer the unanswered questions during this session. For sure, we can spend some hours on this topic alone. So we will get back to you and provide you an update towards the end of this year. Thank you.
Thank you.